Hello, everyone, and welcome to another Altus Trading live strategy session. This is Richard Van Rich here with Jeff Tompkins. Really excited to have you guys with us on. Hope you all had a wonderful holiday weekend. We're back in the swing of the things, and we definitely missed you guys last week. We didn't have our live session last week due to travel, but I think I really did miss you guys. We enjoy doing these every week, and love speaking to all you folks and talking about the markets. But if this is your first time on, you'll notice that your microphone's muted. That's so we can all hear Jeff talk. And if you have any questions throughout the evening, just put those in the Q&A box. And whenever we get to a stopping point or at the end, we'll answer those questions then. If you have to hop off for any reason, this is recorded and will be available on YouTube tomorrow and in the members area later tonight. If you have any questions about your own Trade Alerts account, access to Zillion, Trade Trend, etc., just email support@Altos Trading, and we'll get to those sometime tomorrow. So let's see. Let me get over here to the disclaimer. Trading securities and options involve risk. Prior to buying and selling an option, investors receive a copy of characteristics, risks, and risk of standardized options. Investors need a broker to trade securities and options must meet suitability requirements. Past results are not necessarily indicative of future performance. And performance figures are based on actual trades, including real money results due to time critical nature of trading, broker fees, and activity of other subscribers. There's no guarantee that subscribers will mirror our performance. The performance numbers shown are based on trades users could enter based on the trade signals. Still no green screen. Where you at, Jeff? You there?
Hey, I'm here.
Yours is probably working. I got a cool green screen hat. I got an Altos hat. It's limited edition.
Hey, we need Altos hats.
I know we need to order some.
We need some merch.
So you guys out there, put a one in the chat box if you want some Altos merch. Maybe we can get some put together. There it is. Now I'm official. Zoom's been funky lately on us. We're missing Craig tonight, everyone. He's down in Florida, passed out on the beach, drinking Mai Tais.
Yeah,
just us two tonight.
Wish I was there.
You had a good trip, didn't you?
Yeah, we did. We did a family trip to the Oregon coast last week, so that was
Sweet.
Traveling. So that's why we didn't have our session last week. But had a nice family vacation in the motorhome and made it back safely.
An RV.
Yeah. But
you guys have some good food?
We did. We had, so there's a place called Jetties over in what is the name of I'm trying to remember the name of the town. Nehalem, Oregon. So it's a crab, basically like a crab. It's not really a restaurant. It's like a crab fishing thing. And you just, they have some outdoor seating, but it's like no service. You just basically walk up to the guy outside and order up some crab, and it's fresh caught. They pull it right out of the water and throw it in the boiler, and you eat it right there on a bench. So that's what we did.
Terrible.
Yeah, my wife loves crab. That's like her favorite. Yeah. So she was in heaven, and yeah.
My wife's the same way. First, like my wife's real little. Like the first time we went to like our first date, I've been with my wife 25 years, so I was like 19. I take her to this Asian buffet, and they had these crab legs. And I kid you not, her pile was like the size of like a watermelon.
Yeah.
And I was just like looking at her, just amazed, like, and she tore them up. So now we definitely do the crab legs.
Good stuff. Good stuff.
Yeah. So about like 3 pounds for us. Yeah,
we would have, but well, I guess we did because we had family with us, so we bought quite a bit, but it was like $18 a pound. So it was not cheap.
Yeah.
Could have eaten like 3 of them, but I stuck to one.
Yeah. You're eating fish sticks for the rest of the trip.
Yeah, right. Frozen fish sticks. Yeah. So happy Memorial Day to everybody. Well, I guess it's day past, but big thank you.
Still celebrate.
Yeah, we're celebrating for sure. And thank you to all the veterans out there for your sacrifices and everything that you guys do for our country, and appreciate that more than we can express. So it was nice to have a day off yesterday. Of course, the markets were closed. So today is our first trading day of the week, and lots of things to keep an eye on. So let's go over our topics for tonight. We'll start with our market overview and see where things are on the major indices and map out some important levels to keep an eye on this week. We're going to focus on volatility skew. If you're not familiar with volatility skew, it's an options topic, options related topic. But even if you don't trade options, it's very, very important whether you trade stocks or ETFs or crypto or currencies. It's relevant, and it can give you a lot of good information regardless of whether you trade options or not. But certainly if you trade options, it's an important thing to understand and to use in your trading decisions. So if you're not using it, this will be a really beneficial session tonight. And we'll talk about how to interpret it and what to do with it and things like that. And then we'll open it up to our ticker roundtable and wrap up with Q&A. So I'm going to flip off my camera here and go over to our charts. Let's start out and kind of take a look at what's going on in the market and what we're watching and what we will have on our radar for the near term through the rest of this week until we meet next Tuesday for our next live session. So I'm in our Zillion dashboard. You can see when we look at the major index ETFs, the SPY that tracks the S&P 500, the Dow, the DIA, and then the QQQ that tracks the NASDAQ 100. We're showing sideways trends at the moment. And reason being, it's factoring in past price data. Of course, there's been a big sell-off and then a rebound. So we don't have a whole lot of over the past week or two directional movement, because if you look at a couple of weeks worth of price data, we're just kind of ranging. So we're getting a sideways reading on overall trend. Of course, medium and long-term trends on the at least medium-term trend on the major indices is down. We're still technically in an uptrend on the S&P long-term, and that's largely because we've had such a big run up in the index. Same thing with the Dow. The NASDAQ, as usual, gets hit harder in market sell-offs or bear markets on a percentage basis. So NASDAQ is showing a long-term downtrend, and we went into bear market territory on the NASDAQ, but found support there on the S&P. So those are kind of our overall trends. So when we look at sector performance, even in bear markets or market sell-offs, we tend to have some sectors that are benefiting from that. And after market sell-offs, or when we start to see some degree of a rebound, we'll often see more of these top performing sectors pop in and these are basically outperforming the S&P 500. But the moment, consumer discretionary, energy, and financials. I would say, let's see, maybe going back, 3 to 6 months, energy's been a strong performer regardless of overall market performance or sentiment in the market. So energy's been a kind of a good go-to in 2022. Healthcare, real estate are getting hit hard. Not terrible, but they're starting to kind of turn over relative to the other sectors and the major indices. Real estate, is one that I think is fragile right now, and that's starting to pop up in our underperformers. So we'll keep an eye on that one too, moving forward. So let's take a look at the S&P 500 and map out some important levels to watch. And if you're a Zillion member, I posted last week in the commentary a crucial level to watch for this week, and that was the 4100 level, because we were bumping up against it. I think was it Thursday, and then broke through it Friday, closed strong on the day near the high of the range. And so far that level's holding this week. So that's the one that we are watching really closely. So let me get my drawing tool here so we can take a look at this. So 4100, the reason it was significant a significant level to keep an eye on was this low from back in later February. So this year, of course, big sell-off down in around the 4,100 level on the S&P, and then we found support there and saw quite a big rebound in March. And then, of course, April comes around and we're back below those levels into May. Found support around 3,800. Now, on I think it was a couple weeks ago, but one of our past sessions, we talked about, oops, not the one I wanted to use. Sorry about that. We talked about percentage peak to trough percentage sell-offs in the indices and using those as a barometer for number one, what's a correction, what's a bear market, where might things turn around and turn, where might buyers come in on these sell-offs. So definitely review that on our YouTube channel if you weren't in attendance, because we actually this was right around a 20% peak to trough sell-off. So the high from back in late December all the way down to late May, right into that 20% level, peak to trough, and then we get buying coming in, and you actually saw that happen in one single day, right? So this was on May 20th. Got right down into that 3,800 level, and then buyers came in because that would have been the level that put us into bear market territory, and then we get this rebound. So what we were watching last week was the resistance off this rebound into 4,100, and again, because that was near the low of February 24th, just a little higher than that at 4,114 and change. And so 4,100 being a century mark, we see the break through that level on Friday last week, and got a little bit of a stall in the buying and rebound that we saw last week. But when we look at today's price action, although albeit bearish, with number one, a lower open than the close from Friday and a lower close from the open today, we still saw this 4,100 level holding. Let's see, what was the low today? 4,104. So this is now a big level of support, as it previously served as resistance. And you can see there was the support, and there was some resistance in this area here, more support there, and then support today. So as long as we stay above 4,100 in the S&P, we have a higher potential for a bigger potential for moving higher on the S&P, but we do have, of course, some resistance, and we encountered that actually today. And it's kind of right around, I'd prefer to kind of call it 4,150. But again, these are kind of more zones than they are exact levels that we hit. So see how we had that rejection today? So we may see some consolidation between this 4,100 to 4,150 level, but we want to watch for a sustained break of either of those, because that will give us a better indication of bullish or bearish sentiment. But this 4,150, 4,160 level has been, we've seen a lot of price action and movement off of that level in the past. So I think, if we can get now, if we can hold 4,100 and then get above this 4,150 to 41, let's see what the lows back here were, 4,164, 41. Yeah, so we can kind of get above that 4,150 to 4,175, so half century mark and quarter century mark in that zone. If we can get above that, then we have more room to run. Now, if we, within the next, let's say within this week, if we close back below 4,100, then my anticipation is a move back down into the 3,800 level. If we can stay above 4,100 and especially 4,175, then we have more room to run up here. There's some resistance kind of around 4,250. and then 4,300. All right, so those are our resistance levels to watch over the next week till we meet again next week. So much more resistance than support, obviously. See how we've got, you know, got 1, 2, 3 major levels of resistance to be watching. But if this 4,100 level doesn't hold, we don't have a whole lot of support. You know, that's where we have, I think, more of a chance for a kind of a double bottom around this 3,800 level. But if we look at the, let's see here. If we look at the, let's see. Look at, well, I don't want to get too bogged down with that. Let's just let's keep an eye on those. We'll review kind of where things stand next Tuesday. But for now, for this week, watch 4,100, and then 4,175. So those are probably going to come into play over the next day or two. Very likely tomorrow for support and resistance. Let's see what was the high today? 4,168. So considering the fragility of the market and kind of the geopolitical risks and overall sentiment, I play these things cautiously. I want to see, you know, like I don't want to jump in long on a intraday break. I'm waiting to see confirmation that these levels hold on a closing basis. So so that's what I'm looking at, is I'm looking for closing prices past any of those levels that we marked or mapped out. So currently there is so there was a buy. Let me expand this again. There was a buy from our trade trend algorithm back on May 23rd, triggered on day 2, hit the entry price, the trigger price. Again, that can be found up here, 39.9360. So this is still open. The stop is still down, I think, in my opinion, too far down at around 3,800. And probably, you know, if I had taken a long position off this signal, trail it up below, at least below the 4,100 level. So just because of the resistance that we're encountering right now, but this could end up being a really nice signal. If this 4,100 level holds, it has more room to run. So let's take a look at the NASDAQ.
Hey, Jeff, are you dig into that? Like using folks utilizing Zillion, if you see like market sentiment, and you see buy sell ratios at 97%, would you be less, would that affect your decision to say, well, maybe that's too high, maybe I've kind of missed the move? Or do you?
Yeah, so yeah, the buy sell ratio, I mean, the buys are so high right now because of the algorithm picked up this momentum shift you know, near the bottom of the sell-off. So that I expect that will probably shift much lower this week, because that's been, you know, been elevated and it's been moving up. So I use the buy sell ratio as more of a maybe even a bit of a contrarian gauge. So when it gets too high, that might tell us that the you know, the upward momentum is losing steam. And if it gets too low, that can often be you know, buying opportunities. So if it gets to very high, you know, high or low extremes, that can be more of a contrarian. Or if you're in a long position when it was starting to tick up into the buy, the green or the buy portion of the gauge, then and you know, taking advantage of that as it starts to really get to an extreme, That might be like profit taking opportunity, or wait for it to maybe drop down a little bit. So there's not so. I kind of look at things on a contrarian basis. So when things get too extreme, even if I might have taken advantage of a market rebound down here, I would use that as a potential indicator that things are too extreme now, and may mean it's basically mean reversion. It may revert back to the mean at some point.
Yeah, I was wondering if that came into play. Like if you saw that number was too high, you would take a fresh long. Unless again you had really strong confirmation.
Yeah, I try to like avoid any fresh like new positions at extremes in the gauge, basically. And of course, this is tracking. These gauges track all of our symbols that we have loaded into Zillion. So it should be used kind of as an overall sentiment gauge versus something that's specific to. It doesn't give a specific reading for the chart you're looking at. It's an overall market sentiment gauge, and that's all explained here in the pop-up there. Okay, so QQQ, NASDAQ 100 ETF. Let me zoom out. All right. So we've got a little bit room to run till we hit major resistance. So again, this could just be a bit of a stall. So our major support's around 280. So look what happened here back in early May of last year, and as markets approached new all-time highs and upturn presumed, and then we get the sell-off in 2022, which came down back into that same level and found support. Came back down, so it didn't break until early May. Comes back down to the 280 level, which if we zoom out further, let me clear these. Let's see if we have any technical support there from the past. Scratch this up. So there's not a whole lot. There's a little bit in here if we zoomed in of technical support there at that level, but likely again, what the topic of one of our past live sessions, peak to trough sell-offs on a percentage basis that dictate whether we're in correction or bear market territory, and I provided the percentage levels to monitor in that session. So again, go back and review that. And likely that would most likely coincide to a peak to trough percentage sell-off from the all-time highs of late last year, because there's not a whole lot of technical support there around that 280 level, surprisingly. But that's the one we're going to be watching for near to medium term support on the NASDAQ 100 ETFs. So let's see here. So again, a little bit of room to run for resistance. So we'll be watching this level right around 316 on the Qs for resistance. And then we've got this other kind of somewhat hidden support. I mean, we just had one touch point over the last since the beginning of 2020, basically a year and a half. But there's a lot of price action and upward momentum off that level. So I would monitor this one for support on the Qs. If we do see a bit of a reversal from this rebound. But these are the two major kind of, and if you look at the NDX, you'll see similar price action, of course, and levels, just different numbers. But those are the ones to keep an eye on, and they're big. So I anticipate, and we can look at the implied move for the Qs, but I anticipate we will probably see that come into play this week, just because there's a lot of volatility. We're seeing wide ranges, and the VIX is still above 25, at least I think, as of the close today. We'll take a look at that now. But the VIX is retreating, which is in line with the rebound, right, that we've seen. I think I have to type in the up arrow. That's right. Yeah, so we closed just above 26 today. Now we're near support on the VIX too. So this is also important to watch, along with the levels on the S&P and the NASDAQ. So 25, right, is big support. I see a little at 26 too. So again, more of a support zone. So now if we see the VIX, there's the zone. If we see the VIX move up off this 25 to 26 zone, then we might see, being the inverse correlation between the VIX and the S&P, we might see the S&P and generally the broader indices, as they tend to move together. So the NASDAQ and the Russell move down. If that coincides with those, the resistance on the NASDAQ and the S&P and the support on the VIX. So if we see the VIX pop up, then that will tell us that level, the levels of support that resistance that we mapped on the S&P and the NASDAQ might move down. Now, what we're watching for this week is the VIX to get out of this zone. So what I want to see are two things. So we want to see see if I can try this yet. So we want to see the S&P hold the 4,100 level in conjunction with the VIX closing below 25. So if we can get this week, then we have more of a chance of seeing this market rebound gain a little bit more steam and move higher. Being that we're at very significant levels right now on the VIX and the S&P, that'll likely happen this week. So again, I want to see VIX come down below 25 and close below 25, because that's a major level, right, of past resistance, and which is now support. All right, so if we can do that, and then that 4,100 support level on the S&P holds, then the sentiment becomes more bullish, and I think that we'll reach some of those resistance levels that we mapped out a little bit ago. Let's look at real quick at the implied moves. Let's see here. Keep this. And just kind of, this is another options trick. We've shared it before. So even if you don't trade options, it's still a really handy piece of information. And although it's like anything else, it's not a guarantee or completely perfect, but the options market is basically, in terms of volatility, gives us, it's kind of like handicapping in sports. Like, it gives us probabilities of touch points in the market, levels, and all these things. So we use this in combination with the technical levels that we map out together. So if you look at, let's just look at the SPX, you can, and this is available on any options chain. So we're using Thinkorswim, but you can do it in any options trading platform. And again, if you don't trade options, good information to have, even if you're trading the stock, the underlying stock or whatever, that can give us the expected move by a certain date in the future. And it's based on standard deviations. So that move tends to happen about 68% of the time. So almost 70% of the time, 7 out of 10 times, it's pretty accurate. So we don't know, it's not telling us a directional move, it's just telling us a range to watch out for. So you can see how valuable that would be when you're using it with actual technical levels on a chart. Can give us a lot of really good information. So like for this week, if we want to know like what is the expected move of the S&P 500, and this can be exercise can be done on any optionable security. What is the expected move between now and Friday? So let's see, we're Tuesday. So Friday is expiration would be June 3rd, I think, right? Yeah. All right. So if we just want to know what's going to happen or with a close to a 70% probability within the next week, how much is the S&P going to move? The options expected move is plus or minus a little over 80 points with implied volatility at a little over 27% for this expiration. Okay, so within the next 3 trading days, Wednesday, Thursday, Friday, the options market is pricing in a plus or minus 80 point move on the S&P. So how can we use that information? Well, let's say that let me go back to the S&P here. Oops, let's forget to put the arrow in. So we know that, not with certainty, but with a high degree of probability that between now and Friday, from current price levels, the S&P, the options market is pricing in an plus or minus 80 point move on the S&P. So if we know that 4,100 is the support level, then and that holds, and we want to take a long position, where would it make sense to look for areas of resistance or profit taking levels? Well, somewhere around 4,180, right? Which is right up about here. And implied moves or expected moves are, again, not a crystal ball or a guarantee, and they are sometimes not met, and they're sometimes violated. So markets can move way past an implied move, but it gives us an edge. It gives us an edge of what the options market is pricing in, and options have become so prolific, so widely traded, that they're actually moving the underlying stock. So it didn't used to be that way. Stocks, stock movement was generally driven by a lot of variables, fundamental and technical, but by actual trading in the shares of the stock. But now options actually can move the price of the stock, and a lot of it is things like the implied move. So if it also tells us, what it gives us a good indication of what the expected volatility is. So if we can use that in combination with these technical levels that we map out, it can give us a really, really good edge. In some cases, a 70, 80% edge, which I'll take any day. So we know that the options market is pricing in a plus or minus 80 point move to the upside or downside. That can also help us if the 4,100 technical support level is broken and price close below. What should we expect, as a lower support level to keep an eye on? And often when those expected moves are violated, the market will blow through it pretty strongly. So that tends to happen, more to an extreme on to the downside on a short position. So that's good to know. Now, we're going to talk a little bit about volatility skew, because volatility skew can be used in combination with the technical levels and the implied moves. And so again, you don't need to be an options trader to use this information. If you're trading shares of a stock or an index, really good information to know what the expectation is. So when we talk about volatility skew, there's different ways to, and we'll just actually look at the same expiration this Friday. There's different types of volatility skew, but basically from a high level overview, it's when you get an extreme difference in put and call option pricing. So and same distance, so equidistant from on the chain, the options chain from the current price. So like if we went to the 20 delta on the S&P and we look at the put premium, the price of the puts at that strike 40.45, we see the bids at 11.30 and the ask is at 11.90. So if we go to the 20 delta on, we can use, we'll just go to the 19. If we see that the call premium is a lot different than the put premium, that means there's a lot of volatility skew, and we should expect a bigger move to the upside or downside. And you'll typically see that happen more with put premium. So if you see the put option pricing getting way out of whack, like 3 or 4 times greater than the call premium, that means that, number one, there's a lot of fear in that security that we're looking at. In this case, we're looking at the broader S&P 500 index, but you can use this for stocks as well. There's more fear. So put premium is more expensive, and the options market is pricing in a potential big move to the upside or downside. So right now, if we look at the call premium at a nearby delta, which is bid at 960 and asked at 1010, it's not actually a whole lot different. There's not a lot of volatility skew. It's pretty even. So how do we use that information? And this is just between now and Friday. We can go out to different expirations and you're going to see entirely different scenarios. But that's good to know. So should I be afraid or expect a major down move between now and Friday? Now, it could certainly happen. Again, this is not a crystal ball, but what the option market is telling me is that there's not much volatility skew. In other words, the put option pricing and the call option pricing at equidistant strikes from the current underlying price, the S&P in this case, is not that far off from each other. So right now, there's not a whole lot of fear in the market, relatively speaking, and I shouldn't expect a huge sell-off. I should be prepared for it in lots of other ways, but the options market is telling us that that's not expected between now and Friday. And so, like anything else, we use that in context of other technical and fundamental metrics. So again, our technical levels that we've mapped out, the movement of the VIX and its levels relative to the S&P. So how am I interpreting this? Well, there's not much volatility skew right now in the S&P 500 index options. The VIX is at a support level. The S&P is at a support level with a little bit of overhead resistance. So all those factors are lining up for me to tell me that if 4,100 holds, and it did, today, and if it holds tomorrow, but I want to see it break above resistance, 4,175, then I can be more comfortable that the market sentiment is bullish, near-term bullish. So that's kind of how you use volatility skew. And we'll look at a couple others. Let's actually look at a different expiration. So if we go out to, let's see if there's any volatility skew at the June monthly expiration.
And while Jeff is looking for that, guys, just understand you can watch this over again, and I encourage you to do so because he's sharing something that's extremely helpful for you. And Jeff's not going to do it with a, music and a drum solo where you see it, but this is like one of those gems that you get that you can use this like forever. And I encourage you guys, if you take notes and rewatch this whole section again, because what he's just shared with you is like incredibly helpful long term.
And again, regardless of whether you trade options or not, this is,
Yeah.
I mean, options probabilities are incredible, and surprisingly few retail traders and investors use options. I should say retail stock traders and investors that don't trade options use option statistics to gain an edge in terms of expected moves and volatility skew and things of that nature. And they are really beneficial, both for options and equities traders. And even now, I mean, cryptos, currencies, because a lot of those asset classes have optionable, stock or symbols as well. So really good information. And again, very few retail traders use this or know about it, but big. I think it gives me a big edge. And if you don't know a lot about volatility skew, you can look it up. There's a lot of good information on it on the web. But so remember, it's relative to time. So again, we want to look at different expirations based on our time horizon. So like if we're taking, a trade, we want to obviously, as part of our trading plan, know what our time horizon is, whatever our expectation is, or our reason for putting on the trade. We have to know, where do we expect to potentially get out of this trade, or manage it, or change it, or whatever. And so that's the nice thing about having options expirations, is we can use different time horizons to gauge that. So let's just see. I haven't even looked at this today yet, and I do look at this on a daily basis. Because it's a dynamic thing. It's always changing. So let's see if there's volatility skew going out to June 17th, which is the monthly options expiration. So I'm just going to again look at the 20 delta. We've got a bid at 27, ask at 29. Let's go down, and that's on the put side. Let's look at the call side. 20 delta. Okay, so now we've got, wish I could get this all on one screen. So now we've got a volatility, a little bit more significant volatility skew. So see, well, let's use this one because this is we've got 220 delta strikes. We'll use the 39.40. So 28 bid, 30 ask. And let's see. Use 21 bid, 22 ask. So that's more volatility skew. So there's obviously more uncertainty, more fear. Put option premium is more expensive. And that can be used in context of what the S&P is doing, for instance, because that's what the option chain we're looking at, to help us navigate any movements as they relate to technical support and resistance levels on the chart. So if we see volatility skews start to balance out as we get towards June 17th and the market's moving up, then I personally might become more aggressive if I were in a long position, because I want to see that volatility skew even out. If it becomes very extreme, so let's say like at equidistant strikes from the current underlying price. So right now the S&P is at 4132. so you can use the delta like I just demonstrated, or you can actually add and subtract from the current price. You just want to make sure you're analyzing equidistant strike prices from the current underlying securities price. So if I see volatility skew become very extreme on the put side, so put premium is way more expensive than call premium, and the S&P is selling off, if I see that sell off into a support level, okay, so again, just to visualize that, because that happened right here. If I see that sell off into a support level, big volatility skew is happening right in here. It balances out and then bounces off that support level, and then gets closer to in line, like we just looked at between now and Friday. There's not a whole lot of volatility skew. And again, we're looking at this now in hindsight because it's already occurred. Then that's how I get an extra edge in spotting these turning points at support and resistance levels by watching the volatility skew. It gets extreme and then evens out. And so it works out in the opposite direction. If you see it get extreme on the call side, and call premium equidistant strikes from the underlying security price is becoming more expensive than the put premium on a run up, and we hit a resistance area, like right here, 4,200. Again, so if I see, so we're balancing out now, right? If I see this hit 4,200 and I start to see the skew widen, then if that happens in conjunction with a technical support or resistance level, then I can I can use that to help gauge the move off that level, along with the implied move that we just looked at. So all these should be used, together as a tool. None of them a standalone. They should all be used in conjunction to help us navigate this. So kind of to sum that all up, and then we'll look at have you guys share some stocks, and we can look at, if they're optionable, we can look at volatility skew on them. If 4,100 on the S&P, right, is holding, and price moves up off 4,100, and there's not much volatility skew, the option and put pricing is pretty similar, meaning that options market participants don't have a lot of greed, but they don't have a lot of fear. They're pretty balanced. That can open up the gates to higher prices. So that's what I'm watching.
Super cool.
So yeah, volatility skew. So let's address any questions there, and then we'll open it up to ticker roundtable, and if they're optionable, again, we can look at that and see if there's a volatility skew on any of the stocks that people want to look at.
I'm actually wanted to know if probably need to get Daniel on this, so we can create a new indicator where you plot the premium versus call premium for SPX and track it on the SPX to see the relationship between the two.
Yeah,
that's a good idea.
It is a good idea. There are indicators out there that can do that. You can just look at the put call ratio. There's like put call ratio indicators. Actually, let me show you. I don't know if we have this loaded in here. I can actually show you how to get volatility skew overall really easily. I doubt we have this loaded in here. No, so let me show you this. If you have a broker platform, you can look this up. There's something called the skew index, and the ticker is just SKEW. Let me actually plot this on a line graph because this doesn't trade. You can't trade the skew. There's no options on it, but it gives us really good information. Let's see. I want to go to style. I never use line charts. How do I get a line chart? There we go. Okay, so this is the CBOE skew index. And it's actually a really great tool for timing market sell-offs, because when we see volatility, so I think that we're kind of down around the average right now, around kind of 118. When you see volatility skew, so this again is measuring the option skew between puts and calls on this on CBOE options, when you see it get high, we tend to see a sell-off. So like look at, and high like is, I mean, it's everything's relative, right? But on an absolute basis, 150 is high, 150 or above. So when we see the skew index get above 150, look where that happened, right towards the end of December. And it actually did that before. It gave us a peak before the market sold off in 2022. There was another one, the November sell-off. So I like to use 150 on the skew index as a real extreme for, so when you see the skew index get above 150 and markets hit new all-time highs, be very, 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 very cautious. High likelihood of a sell-off sometime, within the next month or two, I would say. Oops. So skew index is one you can use, Manchu. So when you see it hit extremes, but use support and resistance analysis on the skew index too, so you can help spot skew as it relates to support and resistance. Okay, so like see that 147 resistance area would have gone back there too. So when you see volatility, so this is actually an easy way to see what I just showed you on the S&P. So you remember how between now and Friday, I mentioned that volatility skew is, there's not much there. It's pretty even. And sure enough, look at the skew index, it's low. So the skew has to go up again, right? And it tends to be inversely correlated again. So when the skew index goes up, starts to move up from an even level, markets tend to be moving up as well, because you have all the psychological components of the market, irrational buying, greed and things. And then when it gets to an extreme, fear starts to come in, skew gets really wide, and it has to come back down. And that's where sellers come in, short sellers, covering long positions, all these things, unwinding long positions, and then boom, the markets fall. So skew index very, I'm glad you asked that question, because I intended to show the skew index to you and I was kind of spacing it, but this is kind of an easy way to see overall in the options market what the skew is. So again, not specific to one security, which is why I wanted to show you how to analyze that on a security specific basis, because you can do it with any stock that has options, any index that has options, any cryptocurrency or currency pair that has options on it. So, but this will tell you, the overall skew index, which is handy for analyzing the major indices. So right now skew is very low, and so you can see kind of it's not a perfect timing tool. But you can see how when you use areas of support and resistance in the skew index, again, in conjunction with the VIX and the S&P and the NASDAQ and implied moves, these things all come together to paint a clearer picture to help you, navigate the markets and make trading and investing decisions. So that's skew index. So thanks for that question. Any other questions here?
Couple, yeah. Chris just wondered, is the skew index, what does it track? Is it just all options or the SPX or?
Yeah, so it's a CBOE product. So again, it can't be traded, doesn't have options that trade on it, but it measures options that are traded through the CBOE. So skew on any CBOE options.
And Keith's wondering if the skew could be impacted prior to like major economic reports like this week. We've got the non-farm payrolls, NFP week.
Yeah, definitely. So, to see a really big move in the skew index, it's going to generally be correlated with a big market move. Like as an example, just the most recent sell-off, and then again here in April before the rebound. But again, taken in context of the extremes. So, a movement, this movement down here between, roughly 138 and 118 shouldn't be taken in the same context as this one from right around 156 down into 126, right? Even though, and this one was a little bit bigger, but similar magnitude. So taken in context, yeah. So definitely, I would expect the skew to widen around major events like non-farm payroll, which we do have coming up this Friday because it's first Friday of the month. Non-farm payroll, it's not going to probably create a huge volatility skew, but it could impact it.
Okay. Is there a skew index on just individual stocks that you're aware of?
No. The skew index again is just ticker is SKEW, so it measures the CBOE options. But you can let me escape out of this. You can analyze the skew yourself on any optionable stock, and that's why I ran through that exercise. So just go equidistant strikes. I like to generally use like the 20 delta. But look to see. I didn't do it in this case. You basically want to kind of get as close as you can to subtracting and adding the same price interval to the current share price. So 41.32. If we go down to the 20 delta, 39.40. Now I got to do some math. What is that? Like almost 200 points. Let's just say it's not exactly, but let's just say it's 200 points. If I go down to that strike on the put side, I want to add 200 points to the call side, so that I'm using equidistant strikes on the put and call side to analyze the volatility skew. But you basically want to look for the premium on one side to be way out of whack, so much higher than the other side, or lower, depending on what side you're looking at. But if we're looking at the puts, if we see volatility skew on the put side, we may expect a bigger directional move. We don't know which direction, but generally that means there's more fear in the market. And if we use a contrarian approach, then that might tell us that a lot of people are buying protection. They're afraid premium's gotten way out of whack, and it might actually, from a contrarian perspective, mean a rebound, and vice versa with the call side. So it's pretty quick and easy to just analyze the volatility skew. There's no exact numbers, or you're just looking for something to be way out of whack. And so let's take a couple tickers, and maybe we can see if they're optionable, and look, because we're kind of up on the hour, but I want to give you guys a little extra time to share.
Let's see. A couple came in earlier. AMGN.
Okay, so over here. All right, so Amgen, nice buy there from trade trend May 6th, trigger the next day. Still an open signal with trailing stop up around 250, which is actually a really good trailing stop level, because we got major support here. So this one's already had a big run up, but it's still trading above support. So resistance is pretty strong right up here. It's right on the high from kind of right around 260, 258 to 260. That's some strong resistance. Okay, so those are the major levels I'd be watching for support and resistance. So far, the support level seems to be holding. But if I had taken a long trade off this buy signal, I would definitely be obeying the stop level. from the algorithm. Just because it does coincide with the strong support level. So let's look at because Amgen is an optionable stock. Let's look at Amgen and see. So we're near, we're kind of sandwiched in between major support and resistance levels. So how do I kind of analyze and interpret this? Well, there's being that, the range today was pretty much at the resistance and at the support. We could get some inside days where the high and low reside within the high and low of the range from today, and therefore within those support and resistance levels. But there's a good probability that those are going to be touched again this week or breached. So I don't need to look real far out to determine volatility skew. If my expectation, let's say I'm in a long trade off that signal, is that I could be either stopped out at a profit on my trailing stop, or I might be scaling out of the position or wanting to hold it a little bit longer to see if it breaks that resistance level. So let's see what the options market is telling us. So I might want to look out a week or so.
Hey Jeff, you'll probably want to get it on. I think it's selling SPX.
Oh, I saw that. Yeah, thanks. So I might want to look out, like 3 days might be a little too short. I mean, I could certainly look at that, but I might want to go out to June 10th expiration. So let's just look at, let's see here. So 247.50. So it's about 9 points or so, 20 delta. Problem is there is very little. The spreads are really wide here. Let me see if I can spot them even with that. The midpoint.
It might be the demo platform too. Sometimes the demo platform gets wonky on those.
Yeah, and plus the market's closed, so sometimes spreads widen when the market's closed and it won't turn back to normal. I could add and see if there's even any. I won't take the time to do it. We could see if there's any open interest at this strike, but could be liquidity. Who knows? But anyway, let's see. Mid prices at 119. And then if we look at, so there's actually not, the strikes aren't real flexible on this one either. So this one is 247.50, current share price 256.74. So that's what, about 9 points, and 9 fewer would be 247 roughly. 47. Or no, sorry, we're going higher. 265 roughly. So I might want to look at this 265 strike. So yeah, there is, even if we went down to the 26 delta, there's still volatility skew. I'd want to verify this when spreads tighten up, or if they don't, because if it's low liquidity, I would look at a different expiration. But there is skew here. So there's the put premium at equidistant strikes is higher on the put side, right? So there's fear. And we're up in a resistance zone. So what I want to see is if I see volatility skew continue to increase and the share price to move below this 250 support level, then I would expect to move lower. If I see the volatility skew tighten and there's not as much of a difference between the call and the put price premium, and price moves above, then that gives me more of a green light to for an additional upside move. But because I'm seeing volatility skew on the put side, and this is something I monitor regularly for something I'm trading, so it's not really something you can just do in one snapshot and really get a full picture. I'd want to be watching the volatility skew every day to see if it's increasing or decreasing, so tightening or widening. So if I see the volatility skew on the put side, widen as price moves off a resistance level, that's my signal that this up move is probably over or losing steam, and we're going to move back down. So it's kind of like you want to get like a momentum gauge of it, of how it's changing day to day. Let's see if we can get some tighter bid-ask spreads on the monthly expiration. It's a little bit better. Okay, so we go, let's just go 245. So dollar, $1.35. And then if we go about 10, 11 points up higher, we're at 256, or sorry, 266. So we could use the 260. Yeah, still seeing volatility skew, but again, the bid-ask spread's wide on the call side. But looks like a little volatility skew still going out to June 17th. So yeah, that's an indication there might be a more of a bigger move, and that's what you'll tend to see, anticipated move. What you'll tend to see at major levels. So when you see the volatility skew like we did on Amgen at those 2 expirations, it's not huge, but there's skew to the put side. And when you see that in the context of the resistance level, if we get price movement off this resistance level, and again, a widening of the volatility skew, that tells me that this resistance level is probably going to hold, and Amgen shares are going to move down. It's going to use that. Let's take one more so I can demonstrate that. Hopefully it'll be an option.
Yeah. Vicky wanted to see Lululemon.
All right. That's where my sister works. Lulu. All right, so there's our pending buy, May 26th, got triggered yesterday. This one is down near some strong support from over a year ago. The support zone here between 250 and looks like about 260. So let's look for areas of resistance here. I see one. And when I'm looking for these levels, I'm looking for big moves and shifts. So like if I see, here's why I'm mapping this level right now. When I see a significant move down and then up off that level, that's support. But price is currently below that level. So it's not, it was support back then. Now it's resistance. Okay, here's another one I see. Large move off. And then once we draw our SNR line, support and resistance, because I just drew that one off this price back here without even looking to the right. But then I see it serving as support there as well. So some overhead resistance looks like kind of between 305 and 310 to contend with, and it's a strong one because this move off that level back in looks like early May of last year was so significant, and it then served as support early 2022. And we've seen a lot of price consolidation around this zone. So we may see more price consolidation around this zone, historically speaking. So those are the major levels I would look at for Lulu. Let's see. Let's look at the implied move for Lulu and if there's any volatility skew, because it is an optionable security. So
yeah, Vicky wrote in saying there's a earnings coming out pretty soon. So
okay, so yeah, and you'll often see volatility skew around earnings as well. Does she happen to know the earnings date? I can look it up. If not, I could probably figure it out just by looking at the premium. Unless it's this week, because then
She said June 2nd, 10 p.m.
I was going to say, because if you look at implied volatility, it's through the roof. At all these strikes, implied volatility is really, really high, 130, 150%, 160. Those are low deltas, but like 20 delta IV is at over 140%. That's extremely high. So yeah, earnings implied move is up or down is 28 points. So the options market expects Lululemon to move up or down by 28 points between now and Friday as a result of QE, quarterly earnings. So we can mark those points as a 68% probability move between now and Friday. Again, and then use those with the technical support and resistance levels we just drew. And then let's see what kind of volatility skew exists between now and Friday. So 265, 20 delta. So mid price is 425, 325, 20 delta, 19 delta. So yeah, there's not a huge amount of volatility skew, but there is definitely volatility skew to the put side. So see how the call premium is, and it's partly due to earnings, because a lot of times if people hold long positions in the stock, they might want to protect any open positions with put contracts. But yeah, so the call premium mid price 315, put premium mid price 425. So that's like, 25% volatility skew, or more like 30%, 33% volatility skew between puts and calls. So again, that's good to know, but only in the context of everything else we've looked at: implied move, support and resistance levels, and it can help tell us, that. And the other thing I would look at too, we could actually look at this on the. Let's go back to. So you can look back on option. So you can go back to, we're a little short on time, so I'm not going to do this, but go back to last year's June quarterly earnings release, June 3rd. Positive response from the stock after that release. You can go back and look at the option premium and see if there was any skew back at that time, and see which direction it was, and just have a barometer for this release to know where the skew was and what happened. Again, not a crystal ball or guarantee of what will happen this week, but a really beneficial, useful tool for navigating current prices. So good support down here around the 250 level. Very strong resistance up around the 310 to 315 level. Also support right around 280 to 283 zone. So right now, volatility skew because of QE release coming up. So put premiums high, but you can see there's fear in the stock because the skew is to the put side. So there's fear that the stock is going to have a negative reaction to quarterly earnings.
Interesting.
All right.
That's pretty cool.
Yeah. Well, let's wrap up with any final questions.
No, I think we're think we're set.
You're welcome, Chris. Thank you. Awesome. Just running through to make sure. Looks like James had a nice one on.
Dude, James killed it.
Yeah, nice job. Cool. All right, guys. Well, we'll plan on seeing you guys next Tuesday, same time, same place. If you have any questions in the meantime, you can email us support@altostrading.com. And thanks for everybody's participation and good questions. And thanks, Keith. Thank you, Vicky. And all your participation. So we'll see you guys next week. Have a great rest of the week. It's a short trading week this week. But a lot of big things happening. We got, like it was brought up, we have non-farm payroll on Friday. More quarterly earnings releases on major companies. And we're at major levels in the market. So a lot of things to watch between now and next Tuesday. And we'll revisit everything we talked about tonight on our session next week and see how it all panned out. So thanks again, guys. Thanks, Ed, James, Chris, everybody. Thanks so much. Have a great rest of the week. We'll see you guys next Tuesday.